What happens when AI appraises your home in seconds? Then the AI market gets called a bubble in 2026? You could be negotiating a loan based on a number that's about to move. Fast. I'm going to show you the exact pressure points, where accuracy, bias, and regulatory acceptance collide with investor hype. We'll map the risks lenders worry about, model drift, auditability, and oversight, so you're not stuck with a valuation that crumbles the moment capital flows shift. You'll know what to ask, who to push, and when to walk. Before we move on, please take a moment to subscribe to the channel and like the video. Your bank loves the speed. You love the low fee. But here's the catch. The model that priced your house like a sneaker drop is vibing off a market on an AI sugar high. It looks scientific, it's riding trends, and it's one hot nudge away from telling you your starter ranch is a moonshot. Let's break it down. These systems eat data like a teenager with a bottomless pantry. Comps, active listings, withdrawn listings, permits, property tax cards, satellite tiles, even the listing photos with the aggressively staged coffee mugs. They ingest neighborhood turnover and recent list-to-sale ratios. They map roof age from imagery, lot lines from GIS, and churn out a number with decimals faster than you can open your email. They fold in macro noise, rental rates, demand trends, even climate flags, then call it instant value. It feels like a cheat code. But here's what nobody tells you. That precision, it's theater. Stale comps slip in because county feeds lag. Staging tricks like wide-angle lenses and bleached floors spike the updated score. Seasonality pops, spring bidding wars, summer lull, get mistaken for momentum instead of normal churn. The model isn't lying. It's overconfident. The decimals are makeup. AI valuations behave like rideshare surge pricing. In normal traffic, they're solid, predictable. Then a stadium empties, every ride request hits at once, and the map turns red. Prices jump, wait times glitch, and the algorithm chases chaos. Housing's the same. Smooth street? Fine. Sudden shift in rates or investor appetite? The model sprints after signals it barely understands. Lenders already use automated valuation models for the low-risk stuff. Refi with a small balance and fat equity? Waiver granted, no one walks the property. But there are guardrails. If your file trips the model's skepticism, odd comp spread, data conflicts, or unusual property features, it kicks to a human. The problem is when cost-cutting sneaks in and that guardrail gets thin. That's when people get burned. I've watched markets where vinyl plank floors and quartz counters juiced listing photos and fooled the scoring. It looked renovated. It was lipstick. Underneath, sagging joists, 50-year-old plumbing, zero attic insulation. Models trained to reward updated finishes end up overweighting shine and underweighting structure because photos carry more signal than a PDF permit buried 3 clicks deep. And then there's bias and gaps. Older neighborhoods with funky parcels, mixed-use blocks, or decades of off-market family transfers? The data is Swiss cheese. Unique homes, converted churches, ADUS with non-conforming kitchens, get sanded down to the median. The model wants the middle of the bell curve. Your property is a comma splice in a sentence it's trying to tidy. If the AI boom cools in 2026 like some folks expect, capital tightens, and the big platforms pull back spend. That messes with freshness. Listing volume dips, renovation activity slows, and the model's confidence falls right when you need a clean number for a refi or a purchase. It's the worst timing. Less data, more pressure, bigger consequences. So here's your mini payoff. Watch for red flags now. Reports leaning hard on listing photos rather than permits or inspections. A black box score with no confidence interval, no range, no humility. Lenders skipping manual comps on higher LTV loans under cute pilot language to shave a few days and a few $100. Translation: the model looks certain, the collateral isn't. And if a tiny change in your input swings the value by 5 figures, that's not precision. That's fragility with a clean font. If that's the front door, wait till we walk into what happens when the number is wrong and you try to fight the code. What happens when the algorithm lowballs you by $60,000 and customer support forwards you a PDF? You're staring at a value that nukes your deal, and the only help is a link to a portal that looks like a 2009 tax form. Here's the maze. You call your lender. They say, "We use a third-party AVM." You ping the vendor. They say, "We pull from county data and listing feeds." You email your agent, who sends comps that the model already ignored. Meanwhile, your rate lock dies on Friday at 5 p.m., and every hour you wait adds real money. It's a hot potato with your equity as the glove. The stakes are not cute. A 1-point LTV swing can flip your refi from PMI waived to enjoy that monthly surcharge. HELOC? Denied? Purchase? Contract falls apart, and the seller keeps shopping because the weekend brings better buyers. I've seen refis go from a clean math win to a nope because the model shaved $5,000 and the fee stack tipped the ratio. It's real. It's happening. Now the messy stuff. Unique properties confuse the beast. You own a converted duplex that lives like a single family? The model grabs duplex comps with weird rents and drags you down. A DU on the lot? Half the time it treats it like a shed. The other half it assumes a second legal unit with rent you don't get. Fresh renovations without permits? The algorithm trusts the county, not your contractor. Corner cases go sideways fast. Flood zone maps update. School boundaries shift, or a micro-neighborhood straddles 2 zoning codes, and the score jumps like it drank espresso. This is where cycles bite. When a boom cools, comps move slowly because closings reflect last month's mood. Risk models move fast because capital gets jumpy. Lenders tighten overlays, drop AVM cutoffs, and the tolerances shrink right when data gets thin. Thin data equals fatter errors. The places with the fewest recent trades take the biggest hits because the model fills the silence with its own assumptions. Regulators have thoughts. USPAP still wants credible results. The OCC and CFPB care about model risk, fair lending, and explainability. In theory, you get audit trails, bias checks, and a challenger model to keep the first model honest. In practice, deployment sprints ahead and the governance paperwork jogs behind. You ask for an explanation and get a scorecard screenshot that reads like a horoscope with decimals. Watch the hype tells. Startups flex demo accuracy on cherry-picked sample sets. No regulator-validated testing. Vendors won't show confidence bands because the range makes the number look squishy. And lenders swap hybrid appraisals for pure AVMs to save a couple $100 under pilot language. Cute in a deck. Not cute when it adds PMI to your life for 7 years. Let's talk personal damage. A wrong AI appraisal can bump your rate, tack on PMI, crater a closing, or leave your rebuild number short if the worst happens. And the clock is brutal. Appeal windows can be days, not weeks. You will not win by venting. You win by forcing the process to slow down and document itself. Here's your play. Ask for the confidence score and the top 5 comps the model leaned on. Request an escalation to human review. Submit dated invoices, permits, and before and after photos with timestamps. Push for a challenger model under their model risk policy. If they stall, price a midstream lender switch and run the lock math. The goal is leverage, not friendship, and document every email like you're building a case file.